Hello, I'm Sherry Daniels, and welcome to SlateStone Wealth's 2018 Economic Briefing, held on January the 25th. If you're tuning into this recorded presentation, thank you. And we hope after watching you'll come away with a new idea or a helpful bit of information to guide your investment decision-making. We had a wonderful turnout of clients and guests this year and enjoyed a beautiful setting in Boca Raton's Addison. In addition, this year's event featured SlateStone Wealth's Chief Investment Strategist, Bob Pavlik, a 30-year veteran of the markets. Bob may look familiar to some of you. He's a frequent speaker on financial media, such as CNBC and Bloomberg, and he's often quoted in the Wall Street Journal, Barron's, and other financial publications. Bob took on the global macroeconomic environment. He discussed the strong conditions prevalent in the U.S., including consumer spending, hiring, and business confidence, and covered the European and Asian economies as well. He also shares his market viewpoints, and despite his expectations for a long overdue correction, he reassured our audience that the conditions remain bullish in 2018. You'll have to watch to learn what he's expecting and why.
Thank you. Appreciate it. Thank you, Ellen, and thank you, everybody, for coming out to this meeting today. I hope I can entertain you and inform you at the same time. So my name is Bob Pavlik. I'm the Chief Investment Strategist for SlateStone Wealth, and I'm also the Senior Portfolio Manager here at the firm. What I'd like to do is talk to you about the economy, give you some semblance of understanding as to where we are, and then give you some ideas as to what we're doing with custom equity investment portfolios. So let me just tell you a little bit about myself. I have 30 years in the business. I used to be the Chief Market Strategist at Boston Private, Chief Market Strategist at Banyan Partners, Chief Investment Officer for Oaktree Asset Management. I also I've been a trader. I'm a member of the New York Society of Securities Analysts, the Stanford Society of Securities Analysts. As Alan said, I'm frequently on CNBC, CNBC Asia, and a number of other various locations. I'm also the Senior Portfolio Manager, again, specializing on clients who are looking for an investment portfolio that's focused on individual securities that are handpicked and customized to their unique benefits. What I'd like to do is introduce you to our investment approach at the firm. So as Alan said, we've come together. I'm relatively new to the firm. I'd like to talk to you and walk you through the approach that we're taking towards investment portfolios that are customized using individual securities. So it's a top-down approach. Top-down approach means we look at the big picture, the geopolitical landscape, direction of interest rates, where things are headed in the world. We do that in order to try to come up with what we call a sector and asset allocation. Where is the best place to be putting your money, and trying to come up with weightings for the various sectors. There's 11 sectors for the S&P 500, and try to come up with what our weighting should be. So we use a sort of a four-step approach. In order to identify individual securities, we do a quantitative screen, a computerized screen based on various criteria to come up with new names for the investment portfolio in which to look at. We do a technical analysis. This is looking at the moving averages, the 50, 100, and 200-day moving averages. Whether or not the stock is overbought or oversold, we look at relative strength. We do a valuation analysis comparing the stock's value now to where it has been over the past 5 years. We look at the peer-to-peer comparison. We do a one-year analysis based on where that stock has been over the past year. Then we do a fundamental analysis. And what this all means is we're doing a sort of a holistic, all-encompassing approach to looking at the stock, making a determination of whether or not it belongs in a client's portfolio and on our buy list. Then we manage risk by diversification. You want a portfolio that's not overly concentrated on one particular area. And so we limit the number of holdings, but we get diversification at the same time, which essentially means we're covering all our bases, but we don't have so many names that it's overwhelming and too many names for anybody to actually follow or track. We also have what is probably most important in the investment industry is a sell discipline. And so we have targeted prices when we pick a stock or put a stock on our buy list. And whether or not a stock either surpasses our targeted price, or whether or not the earnings decelerate or fundamentals change for that particular company or for the industry, we decide whether or not we want to continue to hold it. Many times individual investors will buy a stock, but they have no idea as to when to get out of it. So this is one of the key elements of our program here. So let me just walk you through some of the macroeconomic outlook. You know, when I put this slideshow together, nobody really thought that the economy was improving. They're thinking to themselves, what the heck's going on? Well, actually, the economy has improved here in the United States. We got this long-awaited tax bill. We got earnings expectations that are growing. Companies are going to be spending more on CapEx, which is capital expenditures. Consumers are spending more. There's people that are being hired. Large businesses are feeling more confident. This tax reform package that just was recently passed is going to provide $205 billion in tax cuts, which is going to help S&P companies earn more. People have been asking me, you know, what's been sort of carrying this market going forward? What's been driving this growth? Well, the president has a lot to do with it, but also I think there's been a lot of sort of passing over on holiday spending and natural disaster spending. We had some major hurricanes hit this particular portion of the country. And so all that, along with the spending in Texas, has actually helped boost the economy going forward. Now, in Europe, things are actually starting to improve. Europe has been slow to recover from the financial crisis, but things are starting to improve over there. One of the more positive things is the German officials are starting to make progress on forming a coalition government. Inflation expectations are picking up, and actually a small amount of inflation is good for the overall economy. In Japan seems to be another one of these passed over assets classes. It's sort of an underappreciated asset. Reflation is occurring. The Bank of Japan is keeping monetary policy unchanged. It's no longer in a deflationary state. Once you're in a deflationary environment, it's almost impossible to exit out of it. People are waiting for more and more lower prices before they spend their money, and it's just sort of a circular problem that they've been in. Now, one overriding theme in Japan has been, you know, the concerns about North Korea. North Korea certainly poses a threat to the entire world, but mainly to Japan. So Japan is going to have to continue to sort of focus on defense. In China, people have been worried that China's GDP growth is going to start slowing down. They actually reported last week 6.8% GDP growth. That was better than what was expected. China is still a major portion of the world economy at 18.1%. China will remain active in its growth. The only problem that I think we face in China is the amount of debt they have. Debt to total GDP is very high. People ask me all the time, is China going to continue? China is still a communist country, and one of the ways that the communist government controls its people is by growing the economy. So being sort of a cynic, I do think China is going to continue to move forward, and I think the government's going to continue to make that happen. So let's just go through some of this economic data here in the United States. National manufacturing. And I have a pointer here. This pointer I stole from my son, who tapes it to his Nerf gun. So if I screw up with it, don't worry about it. So national manufacturing is doing quite well. ISM National Manufacturing Index has been growing. It's 16 straight months. It represents about 4.7% GDP growth. Durable goods orders have been expanding. Companies that spend for their particular business, their business spending has been increasing. Regional manufacturing, the Philadelphia Fed Manufacturing Index has been doing well, suggests solid growth in the Philly area. Chicago Purchasing Managers Index, highest level since 2016. 61% of the firms are expecting the U.S. economy to grow anywhere between 2 and 5%. So manufacturing, the regional and manufacturing at the national level continues to look good. Little cheat sheet that I created here. If you notice up at the top of each chart, it's a little bit of a color. So dark green represents good, red represents poor or bad, and blue represents neutral. That's my own unique way to handle that, some logical thinking. So looking at the housing market, new home sales have been just doing terrific. Highest level since July of 2007 indicates that, you know, the housing market, at least in the new home sales, is continuing to grow. Existing home sales happens to be a problem. People say, well, why are existing home sales not occurring if new home sales are occurring? Because the inventory levels are low. That's the main issue. People can't move up new homeowners can't move into the market if people aren't moving up and out of the housing market. And so that continues to be sort of a drag on the overall economy. Hopefully that level and that trend will reverse itself going forward. On the inflation front, there's two general measures of inflation, two broadly well-known general measures of inflation. The producer price index, which is where companies operate, and the consumer price index. Producer prices recently had increased about 2.6%, which actually ended a 12-month advance. That's been in place for a while. But producer prices are rising, and that will pinch profit margins on the corporate level. Consumer prices, really pretty much holding steady. 2.1% CPI on the top line, 1.7% on the core level. That's not really a problem. We want to see some inflation here in the US, but we don't want it to overtake anything. Recently, as the commodity prices have been increasing, inflation has sort of crept back into sort of the conversation. But right now, the levels of inflation, especially at the CPI level and sort of the core measurements that the Federal Reserve uses, is not at the point where the Federal Reserve is going to move off their gradual pace to raising interest rates. So what else is actually doing in the economy? The consumer sentiment is actually improving. Highest reading since 2000. Consumer confidence marked a 17-year high recently. I think that's going to continue to grow in 2018. Employment is another big situation. So the initial unemployment claims, that's what people are filing when they go and they get let go from a company. They file first-time unemployment claims. Weekly initial unemployment claims below 300,000 for 149 straight weeks. Continuing claims, the lowest since 1974. So you don't hear a lot of talk about initial claims outside of what's going on in the direct CNBC world, but actually fewer and fewer people are being laid off. Non-farm payrolls, the actual monthly jobs report, it's indicating that the economy is at full employment. Companies are having a hard time actually attracting people with the skill set that they want for their jobs. So the initial unemployment claims picture and the non-farm payroll picture is actually pretty positive. Just moving on to the S&P 500 earnings picture. So you can see here, I listed out earnings growth in 2015 over 14 grew by 0.4%. In 16, I actually fell. In 2017, the earnings growth is still coming in. We don't have a full picture on that, but they're expected to grow by about 10.5%. 2018, this is based on just this past week's data from FactSet. Earnings are expected to grow to $150.56. That's 14.5% earnings growth, as compared to 12.5% growth over the past 30 years. So 2018 is shaping up to be a pretty darn good year. Again, it goes back to the tax package, consumer confidence, business confidence, all this sentiment that's improving, people being employed. So how do we look as far as the market's valuations are concerned? That's the next step. We got a picture of the economic environment. We got a picture of where earnings are growing. How we priced relative to where we have been. So the current market, and this is as of last night, the S&P is trading at 18.8 times. And people will say on TV, 18.8 times, that's kind of expensive. We're approaching 19 times. Sure, but when you realize that over the past 20 years, the S&P has traded on an average of 20.9 times. So we could still go higher before we actually begin to reach the high end. And let's face it, Wall Street usually surpasses the valuation levels that have been occurring in the past. So let's take a look at the technical picture. So the US market is definitely in a confirmed uptrend. You don't need me to tell you that. Genius, Bob. So total number of distribution days. How many times has the market sold off relative to what's going up? We have one distribution day for the S&P 500, one distribution day for the NASDAQ. The S&P 500 50-day moving average is at 2680. That means we have a potential downside of around 5.5% if the market sold off to the 50-day moving average today, which is not happening. Leadership remains healthy. We're seeing multiple breakouts. Various sectors are doing well. What we're recommending is that investors buy on weakness as the stocks that they like begin to break out or move out of a consolidation phase. So recent leadership has been in consumer staples, things that people need all the time, things like toothbrushes, toilet paper, toothpaste, healthcare, technology, retail has also been leading. Consumer staples are trading 1.1% off their new high. Healthcare has moved right back to new highs. Energy continues to remain very strong. So again, in summary, let's take a look at some of the reports that I sort of breezed through relatively quickly. National ISM manufacturing good, durable goods orders good, Philadelphia Fed, Chicago PMI, new home sales, consumer sentiment, confidence, weekly initial unemployment claims, the S&P 500 earnings growth estimates, technicals for the S&P. What's negative here? Like I said, existing home sales, producer prices, what's sort of neutral, the S&P 500 valuations, getting sort of close to the upper end, but not quite there yet. What's improving? Non-farm payrolls. So overall, the economic environment, in sort of this brief summary, is doing fairly well. Now you start to get a picture and understanding of why people are so positive on the market, and the market's running up every day. So I know this page is a little bit crowded, but I wanted to get a lot of information into you. We remain bullish for 2018. I have a target for the S&P 500, a target of 3040, which represents about 7.2% from the current levels. Now, when I came up with this target, we were about 6% lower than we were. I had about a 14% growth or return for the overall S&P 500 for this year. Now, how do I get to that target? So when I started this, my targets were based on both earnings growth and multiple expansion. I saw earnings for the S&P growing to $149.11, which correspond to about a 13% growth from last year. I saw multiple expansion to about 20.4 times. So using my numbers, I got to 3040. Now, as I mentioned earlier with that highlighted slide, the street's estimate is now $150.56. Now, if I use that and the current valuation of the market using 17 earnings estimates, I get to 3205. 3205, and I'm still trying to wrap my head around that. That's the honest to God truth. I haven't published that. I haven't gone on television with that. But 3205 seems conceivable. That's about 13% where we are now. 13% on top of the 6% that we've already gotten, which means we're potentially seeing another 20% return for the overall market. 20% on top of 20% last year. That's a pretty damn good market. I'll take that any day of the week. Again, earnings growth I think is going to come from the tax legislation, the economic news, the manufacturing, the consumer, increased confidence. Remember, business people are only just consumers, they're just doing it on a different level. So if they're feeling confident at home, they're going to feel confident at work. So business leaders are going to spend more. The possibility of this $2 trillion tax plan, that's supposed to be announced next week, $1.7 trillion. That's going to be huge if that actually passes. And I can't see it not passing. Honest to God, who in their right mind would vote against an infrastructure plan? I mean, drive down, well, I live in Connecticut. Drive down 95 in Connecticut, and or New York, you're going to get an infrastructure plan. Areas of the market that I'm emphasizing, consumer discretionary, things that people don't really need, but they want. Amazon, Netflix, you name it, Home Depot. Financials are going to do better in a rising rate environment. Industrials, again, because of the infrastructure plan. Technology, companies are going to always do more with less. They're going to buy technology before they hire a new person. They're going to hire the person to run the technology, but technology can do more. So what are the potential challenges for 18? The Dow and the S&P broke out the new highs on September 11th. They've rallied about 16% and 12% respectively, so we haven't had a major pullback since then. There is a potential for a correction to occur, and I do think one will eventually come. I mean, there's no way on earth that the market continues to go up without a correction. So what's the correction potential? 5 to 11%. That brings us down to the 200-day moving average, which is the 11%, but I don't think we get there. I think we probably get down if we do see a sell-off, and I can't tell you what it's going to initiate it because nothing on earth right now is really pointing to it other than the guy in North Korea. So I think it probably trades down maybe 7%, but I wouldn't let that scare me out. What I think is going to happen, I think the initial sell-off is probably going to be met with buying. Remember, people are just doing this psychologically, and so if you understand the psychology of the market, you have a major leap forward over your competition. So I think it's going to be met with initial buying, and I think as the weak hands get back into the market's going to hit them, and then it's going to take down, and that's our opportunity to really, capitalize on any kind of sell-off in the market. So again, I'm overweighted consumer discretionary, financials, industrials, technology, basic material. Have a market weight on energy. Energy's run up. Now, energy can go either way right now because it's had such a major run up. I want to have some exposure, but at the same time, the world is still awash with oil. And it takes about 22 months for a hole to be put in the ground, and for that stuff to be pumped out and actually add to the inventory. So we really haven't gotten the benefit of all these new wells. I'm underweighted consumer staples, mainly healthcare, telecom, utilities, and real estate. So why am I underweighted those? Because they're cash cows. They're not the companies that are necessarily growing. They're paying very nice dividends, and they'll do well. Some of these will do well, but in a rising rate environment where the company is focused or seen as by Wall Street as being a surrogate to maybe the fixed income area, these companies are going to be passed over for the fast growers. And so in a all equity account, these are the areas that I would be underweighted. Give you an idea of some of the names that we hold in our buy list, in our custom equity portfolios. I put this list up there because I didn't want anybody to think, Pavlik is just off the chart. He's going off the rails with some names that I've never heard of, some 5-letter stocks from India or something. So all these names, I'm sure basically you've heard of: Amazon, Netflix. Becton Dixon is BD. These names have done extremely well. Caterpillar reported a great quarter. The stock was driving the market today. Bank of America, JP Morgan, Schwab, Johnson & Johnson reported the other day. I think that's probably going to be an opportunity to get into that. They actually sold off yesterday. Here's our disclosure. It tells you that I'm not doing anything nefarious, I think. I've read it all, but I don't remember it. And this is all informational and entertainment purposes. And if anybody has any questions, I'd be delighted to take them. And if you want to throw me a stock name, we can play fast money.
At SlateStone Wealth, our opportunistic investment philosophy means we seek to explore cutting-edge ideas that will help transform our world, the way we work and play, and importantly, how we make our world a better, healthier, and safer place for all humankind to enjoy. Our guest speaker at this year's event comes from one of the highest performing ETFs of 2017, ARK Invest. Tom shared some fascinating insights on topics ranging from cryptocurrencies to genome editing and 3D printing. His exciting presentation covered the technologies and companies on the forefront of these innovations, which will disrupt the status quo and bring change to our environment and lives.
Thank you very much, Matt. And I have to say that it's really refreshing to follow Robert, because I can't tell you how many times I come up and speak after somebody right before me talked nothing about gloom and doom and how horrible things were. And quite honestly, we could not disagree more with that. As Matt suggested, we try to look at the world differently, not for the sake of looking at the world differently, but because we're really excited about a lot of the changes that are taking place. ARK focuses on nothing but disruptive innovation. So if I was to ask for a raise of hands, my guess is, how many people here feel like the world is changing quickly? That's a good start, because this would have been a long talk if you didn't agree. So we right on the screen here are 7 of the areas in which we think a lot of innovation is taking place, impacting people's lives, but not only taking place for the sake of taking place, but represent investment opportunities as well. And that's what ARK focuses solely on. We spend all day on, and we're excited to share it with you. Bill Gates said, this is over a decade now, a breakthrough in machine learning would be worth 10 Microsofts. I think we saw Microsoft on the screen there, certainly a major company, exciting. What is deep learning? Deep learning is really the revolutionary front for artificial intelligence. Artificial intelligence has been around for a while. People remember Back to the Future, artificial intelligence, robots, Star Wars, long time ago. But what's really changing now is that machine learning and deep learning have taken the human out of it. Artificial intelligence used to require the human mind to create the rules and the computer would do it for you. Deep learning is built after the brain. The machine can learn, the machine can adapt, the machine can continuously move on. And the big difference there is that now artificial intelligence has the chance not only to stay high level, to impact things that we anticipate ourselves, but things we could never have imagined before. And so it's now looking at things like speech recognition, disease prediction, answering questions, things that have massive applications in changing the world, some that are just convenient. If you use your phone, Siri can start to help you out. You type into Google and it knows what you're about to search for, but before you hit even half the words. And again, I'm here to tell you this is still very early. Think about incorporating this into things like healthcare, cancer prediction and detection and screening, aircraft patterns, weather, agriculture, where should we plant seeds and when? We have an opportunity because of machine learning and the advances of artificial intelligence to not just focus on things that the internet focused on, and it had a pretty disruptive impact on things like the news, certainly, advertising, financial services has changed radically because of the internet, but now major components of the economy, healthcare, one of the largest sectors, financial, certainly, agriculture, things that are going to change lives, change entire portions of the world, and we can eradicate entire worries on a macro level like starvation, population disruption, all because artificial intelligence can help us. And while certainly that has major impacts from a moral, ethical, and humanity standpoint, we're here because I'm here to tell you, you can also take advantage of it from an investing standpoint. So in 1996, if I were to ask you what % of the S&P 500 was made up of purely internet companies, you would have looked at me with a blank stare and the answer would have been 0. But in only 20 years, that number jumped up to 9, almost 10% by 2016. And these aren't tech companies, these are companies solely created because of the internet. So if you think about that with respect to machine learning and artificial intelligence, remember Bill Gates said it would be worth considerably more, and you take a look at the S&P 500, right now that's about $25 trillion in market cap. 10% would be a $2.5 trillion opportunity solely created because of artificial intelligence, deep learning. In fact, that would be about 35 Amazons, if you want it into perspective, to put it a little bit closer to home. So the next one we'll talk about mobility as a service, which sounds like a mouthful. I've heard a lot of jokes about the name, but what it's talking about is that if self-driving cars. And how many people think we'll get to a day somewhere soon where there'll be self-driving cars on the roads in real cities in America? Okay, mixed, that one's good. It's already here. Las Vegas, CES, just recently this month, they allowed self-driving cars completely on the common roads. No driver. And if you would go back in history and you looked at the patent application for the automobile, Congress followed that up in its infinite wisdom by saying that we would never allow such a thing on our roads, to hurtle down the streets and endanger our citizens on top of an explosive, flammable machine driven by amateurs. And 10 years later, the horses were almost completely gone. This has a chance to be, from 1903, pictures of Fifth Avenue in Manhattan had nothing but horse and carriage. There was no automobiles. You couldn't find one in a picture. 1913, the horse is entirely gone. Part of the reason is convenience, luxury, and part of the reason comes down to simple economics. If you look at the US taxi on a cost per mile basis in the United States, it would be about $3.50 per mile. San Francisco, Uber is $2.86, a little bit better. Your personal car, if you factor all things in, insurance, wear and tear, gas, maintenance, purchase, what you're essentially doing when you buy a car is you're prepaying for the miles you're going to drive or ride in. And I'm here to tell you that doesn't have to be the case. In fact, most things in life now we don't prepay for anymore. Computing power, companies use servers, they rent that cloud. You don't need to shell up front. Businesses were allowed to start with much lower capital costs and enter into parts of the economy they never could have before. And if we look at what we think for 2020, that's going to happen in our personal lives with transportation and mobility. 35 cents, think of how much more driving you would do. But not only that, kids don't need to have license. They don't need to be driven. Parents don't have to leave work just to take someone somewhere. And similarly, we don't have to take licenses away and limit mobility anymore, because at any age, transportation can become really more of a right than a privilege. If you think, part of this is not only going to be the mobility of the service, but it's also going to be a massive transition to electric vehicles. And so it's interesting, you listen to different projections for electric vehicles. Certainly the hybrid model jump-started this years ago. But one of the reasons why electric vehicles are going to take over is because, quite simply, they're cheaper and better. They use a fraction of the number of the parts, so they break down much less. We've made giant strides in terms of our reliance on foreign oil in this country, but it would be even better if we got off of it altogether from an economic standpoint, because it would allow for a diversity of energy options to power our transportation rather than relying on one single source. And so we look at this. It seems quite clear to us, we model this out because economics are driving this, not just our personal affinity. And yet we seem to have disagreement from a very unbiased source like OPEC, who, by the way, actually doubled their projection to get to that number, which I guess I applaud them on, willing to go on a 100% increase. But when we do this, and this is completely modeled out at ARC, we see 2022, so only 4 years away now, sales estimates for EVs of 17 million, significantly different than 2 million. We think the market underestimates the opportunity set because they underestimate the ability of consumers to recognize the difference in the quality and the cost. Now, the natural question that you'll have is, if that number is close or even underrepresented, which I think is possible, what would happen to oil prices? And for a long time, since the 2000s, you heard peak oil supply, which was a scary sounding proposition in the US because we were importing a considerable amount of oil from the Middle East, not the friendly or most stable of regions. But I'm here to tell you, I think, and ARC believes, we may have hit or be very close to peak oil demand. And that represents an interesting problem from an energy standpoint for the energy companies. We do think that there is still adoption to be had relative to places like China and India, and we've accounted for that growth. But it's not just EV, it's also the autonomous and the taxi networks that takes cars off the road. And the reason that takes cars off the road is because the average utilization rate of automobiles in the United States sits at about 4.5% of the time. Now, maybe given the traffic I had to get here this morning, maybe it's a little bit longer here in South Florida, but at 4.5% to 5% of the time your car is being used, and the other 95% of the time it sits in a parking space, sits in a garage, that's a very inefficient use of big assets, especially when extrapolated. As we put taxi networks, autonomous driving to the use, if we can get that number to 50 to 60% of our assets, think about the extra capital and productivity that the United States, let alone other developed countries in the world, has to deploy to other things, to tackle other challenges. And that doesn't even account for the increase in productivity that you'll have in a self-driving car, because you'll be able to do work. Or if you'd like, you can watch Netflix, that's fine too. But so And you don't have to take time off of work to drive somebody else. So the economics are quite clear, which is why we look at auto sales also. And we think, and when we released this last year, we took a lot of criticism for this, but auto sales continually then disappointed, which surprised a lot of analysts in a good economy with high consumer confidence. Why were auto sales disappointed? And the reason is because this is already happening. Ride sharing is taking place. The number of 16-year-olds applying for driver's license in California is dropping closer to historic lows in the modern age because Uber is taking over. And that's just the start. So I'll skip this ahead to get to the next. 3D printing. How many people know what 3D printing is? Okay, that's actually much better than most rooms, so I appreciate that. 3D printing is basically changing our idea of what can be done, what can be made, what the physical world around us has to look like in terms of every product that we might use. And it really has the potential to be absolutely revolutionary because production times can be shorter, designers, instead of physicists, can start to design our products. And ultimately, I heard we were talking about pollution in the last talk. We were talking about efficiency. New architectures can eliminate waste, can eliminate materials, can be more energy efficient and cheaper. Those things all sound good. Let me put it to a more applicable, a more concrete example. How many people here would be willing to fly on an airplane right now that had 3D printed engine parts? That had 3D printed parts in the engines of an airplane, pretty critical component. Okay, I see some people saying no, some people saying yes. The answer is if you have flown anytime soon, you already have. And you're still here today, so I guess that worked out for you. Here's the reason why this is going to work. This is still very, very early. The 3D printing had a terrible marketing problem 5 years ago because the problem is they sold the market on everybody's going to have a 3D printer on their desk or in their home. And my question, as yours should be, is why? What were you going to 3D print? Jewelry? I don't know, trinkets? I'm not sure. The consumer side is not the answer, and we don't believe it ever will be. This is about value creation, innovation, it's about efficiency. In your homes, it doesn't have that case. But where it does have a case is for a company like General Electric, which right now needs all of the help and efficiencies it can get right now. So that's why earlier in the middle, towards the end of last year, they made an acquisition of 3 different 3D printing companies because they know this is their future, not a lot of the other old school manufacturing. Because what they figured out was they can take a turboprop engine, something that took them 855 parts to create and put together and to fly, and limit that down to 12. They can do it with 5% less weight, which means less materials overall. It means shipping those materials are cheaper. The inventory of those materials are cheaper. And we were talking about pollution, global warming, environmental standards. Well, you can do it with this can create fuel savings of 20%. And it's going to be a lot easier to cut fuel savings by 20% on all the airplanes than it is going to be able to get a lot of people to stop driving. So this has real impacts. This is not just business. This is not just engineering. This has real world application savings. The world has the potential to be a better place because of technology. But because people got lost in the consumer side of the story, what they've missed is that there are growth rates, and Woolers, Morgan Stanley, Credit Suisse, those are all financial firms, and so the stocks did quite poorly in the last couple of years based on the consumer story falling apart. So they got burned and didn't really want to focus on this. But McKinsey's not a stock company. McKinsey's a consultant. So they were willing to look past stock prices and say, what are the applications of this? Is it a good thing to shorten production times? Is it a good thing to produce with less waste and less materials? Is it a good thing to be able to design in a ways never possible? Yes, yes, and yes. GE thinks just on its costs alone, it'll save between $5 to $6 billion a year in its own cost lines, and that doesn't include revenue growth. And so we think that there's a potential, or McKinsey does too, for 50% annual growth rates in this space. 50% annual growth. That's real growth, and these are investable opportunities. And it's just begun. You haven't missed the story. When you look at its penetration into the prototype space, it's made significant inroads. But when you're talking about its molds and tools, and certainly in some of its non-consumer products, it's just beginning. But as GE shows us, there's a reason that this is going to happen, because it has to happen. So I'll shift gears a little bit, focus on healthcare. Healthcare is interesting because healthcare impacts every single person in this room, every single person on the planet. It also certainly impacts the economy and the government as well, as we have unfunded liabilities in this country. And as we look at longer lives, the question is, will there be higher costs? But the idea that we can cure people might not, as the quote here shows, it's not new, it just never worked that well. Well, again, this is an area where technology is creating new change. We started manipulating genes in the 80s. We finally got a whole human genome sequenced in 2001, but the cost of that was astronomical, for one, and it took computing power that really we just don't have available for this. However, what we've seen is that the cost of DNA sequencing has dropped from the tens of millions of dollars per genome to about $1,000. And $1,000 is an amazing drop. It creates new opportunities, as you'll see. But that's not where we need to stop. We believe that we need to get this, and it will get to about $100 per sequence. And what happens then? What happens then is that every single one of us will have our genome sequenced every year at our physicals. And we'll start to catch cancer in stages 1 and 2, not in stages 3 and 4, where we can treat it, cure it, expand lives, make lives better. Also a massive economic opportunity. And the reason in part is because CRISPR technology is coming on. So CRISPR is not only easier to use, you can see how much faster it is than what the technology was in the early 2000s, but look at the cost of that per pair of nucleuses. When you're talking about a drop from about $5,500 to $30, you open up the possibilities. You open up the total addressable market and the unit economics to allow for efficient and scalable editing. And the cost, I mentioned this when you can see the cost decline over that course of time. But really, again, the application is the important part. And right now there's 10,000 monogenetic diseases, with very few of them are being treated or able to be treated or even targeted. Monogenetic means one gene failed or mutated and causes the entire disease. Only 5% can be treated today. We think that with the opportunity, when you talk about the opportunity and you talk about CRISPR, that's addressing all of these. The potential to cure all of those diseases, which if we can, is about a 70 billion global opportunity in revenue each year. You can see, we'll skip this, but it's certainly starting to gain attention. And when you talk about what would this do for stocks that are focused on this, well, we use history as an example. History may not repeat, but it does tend to rhyme. The CAGR on the companies in Genentech during the 80s, when they came out with new gene technology, they grew at a rate of 47% per year. An 11-fold increase in the stock in only 6 years. That was when, that was during a period of time. Certainly we had strength in the market. People who ask, is there a bubble in this technology today? I would ask how many people in the room can name the CRISPR stocks. There's about 5. Most can't. So you're certainly not alone. And the reality is that the market in the last week or so, and the last month, is just starting to realize what a powerful opportunity this is. The FDA has come out and said that it is absolutely going to increase the speed of generics and lower the pricing of drugs. Big pharma, that's not a good thing for the big pharma stocks. What it is a good thing is for the companies who are leading innovative new treatments. Because when you look at treatments like this, when you look at treatments like a company like Kite has a drug that focused on non-Hodgkin's lymphoma. And their trials only allowed for people who had failed multiple other courses of treatment. So they basically had the worst of the worst patients. And they had a complete remission rate of over 50%. Now, it's still early, And Kite actually got acquired after that. So you can see pharmaceutical companies are recognizing they need to get into these spaces because generic drugs are not going to cut it. Just keeping people alive, sustainable, while the drug prices might come down, is actually more expensive than curing them. And even if that cure comes at doses of in the hundreds of thousands per dose, it economically still makes sense for everybody, including the insurance companies and the government, which is why this is going to happen. So we'll touch on these last couple real quickly, but mobile payments, I heard Robert talk about Asia, and I can tell you I was in Asia with our CEO last week. We were in Korea and Tokyo, Japan. This is an area where Asia is so far ahead of the United States that most people don't realize this is going on, but it's a massive, massive opportunity in mobile payments. The future of all payments is mobile. We don't realize that necessarily in the United States because we have entrenched barriers such as credit card companies and banks that don't really want to lose their clientele to tech companies. But at the end of the day, not all of us walk around with an ATM or brick and mortar bank, but we do all walk around with these things. In China, 3 years ago, Yum Brands China, the 5th largest restaurant company in the world, didn't take even credit cards. It was cash only. Today, almost 40% of all their transactions take place mobile to mobile with no bank or credit card intermediary involved. 3 years, 40%. And that's not stopping there. That's just the start, as this, again, is very early technology. When we look at this, the penetration of smartphones, even though it seems ubiquitous, it still has a lot of growth left. But by 2020, we think could be about 75%. That opens up a radical new market. And it's key because a lot of the world does simply not have the infrastructure in place to have built out credit card or built out banking systems. But they leapfrogged the United States in mobile technology because they didn't have telephone lines. So when they went mobile, they went completely wireless. And in many cases, countries you would never think of as technological leaders have better mobile infrastructure than we do here in the United States. Now, Asia has a pretty good telecom infrastructure even in their developed spaces, like Korea, like Japan, because they made it a priority. And you can see the sharing economy allows for frictionless platforms. Without fintech or mobile payments, you couldn't have things like Uber, you couldn't have Airbnb, taxis, some of these are in Asia. But again, when you think about the size of mobile payments, we often massively underestimate the numbers in the US because it's still very, 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 very small here. But it's not in Asia in particular, and other developing place. In fact, China's had a 5-fold increase of that in the last 2 years. They did, in 2016, mobile payments in China, 1.2 trillion individual transactions. Most of them accrue to companies you've actually heard of, like Alibaba, Tencent, JD.com tries to get in on that as well. There's a few others. Those are investable opportunities for us as well in the United States. These are in large public companies, SoftBank in Japan. It's also the data. Don't forget about the data. It's not just the payments. When you have data, you have the ability to command a premium. You have the ability to sell your assets. We saw LinkedIn a couple years ago get acquired by Microsoft. It wasn't really because they just wanted a fun social media platform. They wanted everybody's employment data, and they got it. And so you can see there's a huge premium. Robotics is interesting because everybody thinks about robotics in a lot of ways. There's a lot of emotions brought up by robotics. The big one for us is that there is a massive cost decline in robotics taking place. And when there's a massive cost decline, the number of industries in which robotics can penetrate is set to explode. I'll use Amazon as a reference. At the end of 2013, Amazon owned a total of 1,000 robots in its warehouses. Today, that number's over 100,000. That's a 100x increase for Amazon. Meanwhile, Amazon is getting 50 cents of every single dollar that goes online. So their capacity has expanded dramatically. Their costs, their margins have tightened, but that's good for our consumers because your prices have been able to stay low. And that's all while one of the most misunderstood numbers in the economy is that only about 12.5% of all US retail takes place online. It's personally probably closer to 80 for me, but I live in Manhattan, and you don't really want to go out shopping there anyway. It's better to have it delivered. But 12.5%. I don't know what number that number is going to top out at the United States. It's 15% in China, but whatever number you'd like to put on it, my guess is that tops out eventually somewhere near much larger than 12.5. Robots are facilitating that, and they're getting better. They're doing it faster, they're doing it cheaper, they're getting better even relative to humans. Yet the employment in the auto industry has actually grown over this time. And we think that that's going to continue as it seeps into the other parts of the economy. And so as that picks up, robotics and automation is set to get into every part of the opportunity. You can see the growth rates associated with it. You can imagine it. Most robots still are in the automotive industry. I know we perceive it many ways, but it's still mostly in the automotive. That's set to expand. Imagine the opportunities for investment. And I'm sure in the Q&A session, I'm going to get a question about employment during that time, and I'll welcome that question, but I'll leave it for then. And then finally, and I'm just going to spend 30 seconds on this because I know the questions will be different, crypto assets. The 30-second, here's my 30-second answer on this because we do focus on it. People ask all the time, is this a bubble? At the bubble for the tech and telecom, internet stocks reached an amazing 6% of the global GDP. Which was way too high, obviously, especially given where the technology was. Right now, crypto assets, and there's over 1,200 of them, are less than 1% of the global GDP. Now, I mentioned there's over 1,200 of them. We're bullish on crypto assets, obviously, since it's one of our big ideas, but most of those 1,200 will be worth zero. Now, but the blockchain is amazing technology. It is going to be incorporated into almost every aspect of what we just talked about today. And the fundamental blockchains, the Bitcoin, Ethereum, et cetera, are set to have massive value. It's a rapidly changing space. It's very exciting. Certainly willing to answer any questions you have on that. And I think with that, I will end it there. So thank you very much. I appreciate the opportunity to speak to you today.
Thank you for tuning in to this recorded presentation, and I'm pleased if you've come away with some new piece of information that will be helpful. If you're watching as a guest and you're interested in learning more about SlateStone Wealth, our people, and our services, we welcome a phone call or email from you. Our services are available to a wide variety of investors and are tailored to meet specific needs. Whether you're looking for investment management, investment consulting, life planning and guidance, or a combination of them all, our team of finance professionals are here to help explore your objectives and to handcraft a plan that will get you to your desired destination. From our offices in Boca Raton and Jupiter, Florida, to Dallas, Texas, and New York, we have the resources and expertise to build a lasting partnership of success with you and your families. Thank you for watching.